Hello class, welcome to Chapter 4, Accounting for Merchandising Operations. So in the first three chapters, we completed the accounting cycle for a service business. And the service business is the one that sells time. An example would be a financial service, a bank, or a school, private school. So in the first three chapters, we did not have to sell any physical merchandise or goods. So we had fewer accounts and our accounting system was fairly simple. So right here, this was our income statement in the first three chapters. We just took revenues and we usually had one revenue account we called some kind of fees, consulting fees or fees income. And then we subtracted expenses and we got the bottom line, net income or net loss. Well, in this chapter, we're going to talk about the merchandising business. A merchandising business is a retail store or a distributor, wholesaler. So now we're going to have physical goods to sell. So as a result, we're going to have a bunch of new accounts, such as cost of goods sold. That's a new expense account. So it's an expense. And it has a normal debit balance. Instead of one revenue account, we will have at least three, sometimes more. And our main revenue account is now going to be called sales, not fees, but sales. With the normal credit balance, it's a revenue. And you're going to have two contra revenue accounts. These are their names, and I'll show you those again a little bit later. So these are new accounts on the income statement. So if you look right here for the merchandising business income statement, we now have more lines, more accounts, so it becomes a little longer. The idea is the same. You take revenues and you subtract various expenses and contra revenues and you get the bottom line. But because we have two contra revenue accounts, we will subtract them. So we take sales minus SR&A, which is sales, returns, and allowances, less sales discounts. Again, both of those accounts, they look like expenses. They have normal debit balance, but we classify them as contra revenues. And then we get net sales. So what is net sales? It's sales less returns, allowances, and discounts. After that, we have to subtract COGS, which is cost of goods sold. So the difference is called gross profit. Profit before we pay for operating expenses. Sometimes you can think about it as a markup. If I sold a marker, I sold the marker for $1 in my store, but I paid 60 cents for that marker myself when I purchased it from a distributor. So that 60 cents is my COGS. So my sales dollar minus cost of goods sold, how much did I pay for that merchandise? Cost of goods sold. Sometimes it could be called cost of sales. And the difference is 40 cents, dollar minus 60 cents. It's a markup or gross profit. The amount of money we have left to pay for expenses. And then we subtract expenses. That line is still there. Your regular expenses, rent expense, insurance expense, salaries expense, and so forth. And we get net income. So these are four new income statement accounts. This is really the only new balance sheet accounts, but it's major. If you think about any retailer such as Home Depot or Amazon, this is most likely going to be the largest account among current assets. It's a permanent account, plus minus normal debit balance, and we're going to be using it a lot. This account we will use a lot. So I'm going to be talking about buying merchandise first, and then we're going to be talking about selling merchandise. So when we buy merchandise, we will increase and decrease this account, merchandise inventory. I usually abbreviate it as MI accordingly. So I'll come back to this, but so let's go through through the chapter. So right here, guys, merchandising activities. And again, I will talk first about acting as a buyer. So I'll separate. We have to buy merchandise. We assume as a merchandiser, we do not manufacture it. So we have to buy it from manufacturers or wholesalers, distributors. And so we will have with you these concepts of purchasing merchandise, purchase discounts, purchase returns and allowances. This is us getting a discount, as returning damaged merchandise. And we also will talk about freight on FOB shipping point. And then I'll have a series of new journal transactions for us acting as a seller: sales, sales discounts, sales returns and allowances, and freight on FOB destination. We will have one new adjustment. So again, in this chapter, we're pretty much going through our 9 steps of the accounting cycle, right? So we will have with you right here about 4 to 5 for purchases and 4 to 5. So 8 to 10 new journal transactions. So when we're talking about journalizing transactions, we will have 8 to 10 new transactions. We will have one new adjustment. And guys, we will still have 4 closing entries, just like in chapter 3, but we will have with you an expanded, longer step 2. Because we have more accounts to close, step 2 of the closing process will be different. I'm not going to talk much about financial statements formats. I already showed to you how the income statement is supposed to look for a merchandiser. And then there are 2 ratios in this chapter. Okay. So, we already talked about it. The service company's income statement, right? Revenues minus expenses equals to net income. For a merchandiser, it's longer. We go from net sales, and I showed you how to calculate net sales. That's sales minus sales returns and allowances minus sales discounts, minus COGS equals to gross profit, minus expenses equals to net income. And these are the companies we're dealing with in this chapter: wholesalers and retailers. And again, these are examples of income statements for a service business right here, and for a merchandiser right here. Okay, this slide is going to become very important, this concept for us, very important in chapter 5. So if you think about just the inventory account, right? It's a permanent account. We rarely sell everything. So we start with some beginning inventory, right? We have some items on the shelves in the beginning of the period, and then we make additional purchases. We're going to buy merchandise, so we're going to add it to the shelves, right? And so together, my beginning inventory plus purchases, or net purchases, is equal to so-called MAS, M-A-S, merchandise available for sale. Everything I have for sale. And again, my goal is to sell as much as possible, but in reality, I'm not going to sell usually my entire inventory. So whatever I don't sell stays with me, stays on the balance sheet. This is ending inventory. And again, what is ending inventory? This is the balance sheet. This is the merchandise inventory on the balance sheet. And then ending inventory, of course, for the next period, becomes beginning inventory. And again, plus purchases, blah, blah, blah. Whatever we sell goes on the income statement. So merchandise that we sell is considered to be COGS, cost of goods sold, and it's an expense, and it's listed on the income statement. And since it's gone, sold, we're going to close it and make it into zero. So only this part, of course, only the balance sheet part continues to the next period. So let's take a look at page 206, quick study 4-3. Let me go there. So quick study 4-3, merchandise accounts and computations. So we have 2 companies. We have a merchandising company with a bunch of accounts and balances, and we have a Krug service company also with various accounts. In the instructions, it actually says that not all information may be necessary for the solutions, and it's usually case in life and in accounting. Don't try to use every single account. Just pick the accounts, the facts that you need to solve the problem. So A, compute gross profit. Now they call it goods available for sale. I prefer merchandise available for sale. Doesn't really matter. Mass or gas, goods available for sale, and COGS for the merchandiser. So here is our merchandiser. So how do we calculate with you, first of all, goods available for sale? So goods available for sale would be my beginning inventory, which is 5,000, plus net purchases, which is 3,900, right? So again, beginning inventory plus net purchases gives me goods available for sale. So 5,000 plus 3,900 equals to $8,900. Cost of goods sold. So to calculate cost of goods sold, we now have with you merchandise available for sale. So if I look at this formula, I have merchandise available for sale. So if I need to find cost of goods sold, I simply need to subtract ending inventory, right? So if you look at mass or gas, 8,900, find ending inventory minus 1,700 equals to cost of goods available for sale, and that's $7,200. So again, gas or mass minus ending inventory. And the next one is gross profit. So gross profit is simply net sales. I'm not going to go there. It's gross profit is net sales minus cost of goods sold. So we have cost of goods sold right here, 7,200. So we have net sales, 9,500 minus 7,200 equals to, yes, you're correct, $2,300. So those are good numbers to know and understand. Again, based on this slide, your beginning inventory plus net purchases equals to mass, but mass is also equal to ending inventory plus cost of goods sold. So you can find any of this if, I can find, or I can say that, my beginning inventory is mass minus net purchases. My ending inventory is mass minus COGS, and so on and so forth. Okay. B, use the above information from a service company and from a merchandiser to compute net income. So what is net income for Krug Service Company? There is a lot of data here. I just need revenues, 14,000 minus expenses. So 14,000 minus 12,500 equals to $1,500. You're correct. That's net income for Krug Company. Net income for Kleiner Merchandising Company is going to be gross profit minus expenses. Gross profit, 2,300 minus expenses, 1,450 equals to $850. So that's a quick study for -3. I hope it makes sense. Okay. So let's move on. Inventory systems. GAAP does not care which system we use. We can use perpetual systems, and here is a definition. I constantly update pretty much my merchandise inventory. At any point, I know approximately how much inventory I have. When I sell, I decrease inventory. When I buy merchandise, I increase inventory. When I return as a purchaser, when I make a return, I decrease inventory, and so on and so forth. So that's perpetual. It's a little bit more complicated, but it's more precise. Periodic inventory is where we're gonna update the inventory account only once a period. We're gonna physically count it and just update the inventory account. Now, we study periodic inventory in Business 7. In this class, it's in the appendix. I'm not going to require you to do it. We're just going to focus on perpetual. And in reality, even small businesses, when they use barcodes and electronic systems, it's easier and easier to use perpetual inventory systems. So everything that I'm going to ask you is going to be about perpetual system. Okay, so we're going to talk about new journal transactions, and we are going to wear a hat that says buyer. We are a purchaser. We are a buyer. So every purchase we're going to make is going and related transactions is going to impact this account, merchandise inventory. So we're going to have some beginning balance, BB. When I make purchases, right, my inventory will go up. So we're going to debit this account. If I have damaged inventory, damaged merchandise, I'm going to make a return. It would be called purchase returns and allowances. Now, it's not a separate account. Under periodic system it is, but for perpetual system we will simply decrease inventory, because if I make a return, I send damaged or wrong merchandise back to the seller, and I'm going to decrease my inventory. If we're going to get a purchase discount, we're going to pay early. I'll show you an example. And so, the seller, the manufacturer will give us 1 or 2% off. That purchase discount is also how much my inventory is going to go down, right? I am paying less for my inventory as a result, so I'm going to credit decrease inventory. I do not have a separate account called purchases discount. If we're going to pay for freight, and this is a little strange, it's not an expense. If I'm paying for transportation of freight in, it increases the cost of my inventory, right? So if I bought a marker for 60 cents and I had to pay 5 additional cents for freight, for transportation, then the actual cost of inventory of that marker is 65 cents. So again, freight in is not a separate account. And at the end, of course, you will have ending balance. So these are types of transactions we're going to deal with. And as I mentioned, practically in every transaction, in most of them, we will have either a debit or a credit to merchandise inventory. So here's the first example. We purchase merchandise without a discount. We bought $500 of merchandise for cash, debit inventory, MI, credit cash. What if there is a discount, right? A lot of times the sellers want to collect money from us as early as possible. We want to pay as late as possible. Time is money. So even though the seller is giving me 30 days to pay for merchandise, they sometimes want to encourage me to pay early. So this is an example of a credit terms with a discount. So I would read it as 2/10 net 30. So if it just said net 30, that would mean I have to pay my bill, my invoice for the merchandise within 30 days. But if there is 2/10, that means, yeah, I have to pay within 30 days. But if I pay within 10 days, I would get 2% off my original invoice. It could say 1/15, it could have 2/10, 1/15, so it could have a series of discounts. And guys, how do you count days? Just add 10 days to the date of the invoice. So if it said we purchased merchandise on April 2nd, so plus 10 days is April 12th included. If I pay up until April 12th, I get a 2% discount. If I pay on April 13th, I do not get a discount. So here's an example. On November 2nd, we purchased $500 of inventory on account, 2/10 net 30. Again, debit inventory, credit AP, right? We bought on account, on credit. So here's an example of the invoice. The terms are right here. We are the buyer, Zaymart. The seller is Trex. This is the seller, we're the buyer. This is the freight designation. We'll talk about it later. FOB destination. This is, the prices. Okay, let me go back for a second. November 2nd plus 10 days equals to November 12th included. So if I pay up to November 12th, and here I pay on November 12th, I'm going to get 2% off. How do we journalize for it? I pay off AP. AP was $500. I get 2% off. So one way to think about it, I always think about it, this is 1%, right? Just remove 2 zeros, so divide by 100. So this is 1%. $5 is 1%. I need 2%. So multiply it by 2, you get $10, right? What is $10? That's a purchase discount. But where does it go? It goes to merchandise inventory. Why? Because it decreases the amount I pay for my inventory. Merchandise inventory is plus minus. So when we credit inventory, it goes down. How much is the check you're sending? $490. That's a plug-in, right? Or it's 98% of $500. So again, debit AP, credit MI. What is MI here? It's the amount of the discount. And credit cash. I want to go back to my T account for a second. Right here, that's the purchase discount, right? This is the amount of the purchase discount. That's why we credited that $10 because it decreases my initial inventory. And guys, the next slide shows to you how it looks like, right? So if you look at your inventory, I bought it for $500. I got a discount of 10. So what's the cost of inventory? Is $490. And it will become important when we're going to start selling that inventory and calculating gross profit. If I paid on December 2nd, remember the discount period was over on November 12th. So if I paid on November 13th or afterwards, like here I'm paying on December 2nd, which I guess is the end of net 30, then there's no discount, right? There's no credit decrease to inventory. Your debit to AP and credit to cash are equal. Again, compare with the discount, you're paying $490 in cash, and without a discount, you're paying $500 cash. I hope it makes sense. One more concept here has to do with purchase returns and allowances. Now, from the warehouse point of view, they're different. I don't like the merchandise, so it's damaged merchandise. I contact the seller and they say, please physically return it to us. So merchandise returned by the purchaser to the supplier. That's called a purchase return. Or the supplier, the manufacturer, the seller says, just keep it. We will give you an allowance. I don't want to call it a discount. We will decrease the amount of money you owe us, but you don't have to physically ship it back to us. And that's called an allowance. From the accounting perspective, they are the same. So we call this, it's not an account. We call this type of transaction PR&A. Purchase returns and allowances. Here's an example. On November 5th, we, the buyer, issue a $30 debit memorandum for an allowance from Trex for defective merchandise. Pretty much my inventory costs me less, right? $30 less. So that's where it goes. This allowance does not go to any other account but merchandise inventory. So purchase returns and allowances, whether you have a return or an allowance, it decreases the cost of inventory. So all we do, we debit AP, which means what? It means that we owe less money, right? $30 less we owe based on the invoice, and my inventory goes down because the inventory represents the dollar amount, not the number of items. Here is an example of the return. We purchased $250 of merchandise on June 1st on credit 2/10 net 60. So debit MI, credit AP. By the way, sometimes students make a mistake and they start calculating this discount right away. I don't know if I'm going to get a discount on June 1st. I will know whether or not I'm getting that discount on the day when I am sending a payment. On June 3rd, Zaymart returns $50 of merchandise before paying the invoice. So we make a return. What's the transaction? Debit, decrease AP, credit, decrease inventory. So now the question is, how much is my invoice? AP represents the amount I owe, the amount of my invoice. So I still owe $200. So we are paying on June 11th. Okay, let's now think. June 1st plus 10 days, June 11th. Do I get a discount? Yes, I do. But what's the base? The base is not the original $250 because you do not get a discount on the amount of returns or allowances, right? So we owe $200, we get 2%. Again, remember, cross out 2 zeros. That's 1%, multiply by 2, that's $4. Credit merchandise inventory, cash is the difference. We're sending a check of $196. Okay, let me talk about this concept of freight. So there are two different shipping terms. FOB, which stands for free on board or freight on board, shipping point versus FOB destination. And the question here is, at which point, where is the title for the merchandise? Where does it transfer from the seller to the buyer? And guys, the title is just like a title for your car. It's the proof of ownership. So here is an example. I am Macy's in Hayward, and we are buying, sneakers from Nike in Portland. So Nike is the seller, Macy's is the buyer. So what's the shipping point? It's the geographical location from which the merchandise is shipped. So Portland is shipping point. So if we have FOB shipping point, that's where the title transfers from the seller to the buyer. So in Portland, it becomes I am the buyer, it becomes my merchandise. So the title is mine. As soon as they load up, Nike loads it up on the truck, it becomes my merchandise. So I am responsible to get that merchandise to Hayward. I have to pay for freight. And if there is damage happens during the transit, I am the one who is going to pay for the damage. So usually I have to buy insurance. So under FOB shipping point, buyer pays transportation, the freight charge. Under FOB shipping point, goods in transit owned by the buyer, and the buyer has to pay for merchandise. Okay, let me see here for a second. I think that actually buyer pays, so it would be merchandise. If it's a buyer paying for transportation, then guys, this would be a transaction. The amount that we pay for freight goes into the merchandise inventory account. And I showed it to you before, sorry about that mistake, right here, right? If I pay for freight, it's not a separate account, it's simply an increase to merchandise inventory. So if we pay for freight, we debit merchandise inventory. A different example, let me save this, is if we have FOB destination. And by the way, we negotiate this with the seller before we actually start buying from them. Of course, for us, for the buyer, FOB destination is better. When do we get the title? In destination. What's destination? Hayward. So Nike has to pay for shipping, pay for insurance, get the goods to Macy's store. As soon as they put them off the truck, then the title transfers to us as a buyer. So under FOB destination, who is responsible for freight? The seller. Under FOB destination, the seller owns goods in transit, and the seller has to pay for transportation. So if you're paying for transportation, then it's an expense to you. If you're paying for transportation as a buyer to get it to your warehouse, then it becomes an increase to your asset account, which is merchandise inventory. If you're paying for it as a freight out, it's an expense called delivery expense. I hope it makes sense. So here's an example. We purchased merchandise on terms of FOB shipping point, which means we have to pay for freight, and that $75 freight is an increase to inventory. It's not an expense. Okay, this is the last thing I want to do. This is part 1 of the video, and then I will do the rest of the chapter in part 2. So let's take a look at page 209, exercise 4-3. And this exercise gives me various transactions that I just described. Transactions that deal with purchases, right? Recording purchases, purchase returns, purchase allowances. So first transaction, I will go right here. I purchased 4,600 of merchandise from Lion Company with credit terms 2/15 and 60 on net 60. If I pay within 15 days from the date of the invoice, I will get 2% off the outstanding balance. Otherwise, the entire amount of invoice net is due in 60 days. Dated April 2nd. So right away, April 2nd plus 15. If I pay up until April 17th included, I will get a discount. And guys, FOB shipping point, again, I'm going to go up here. FOB shipping point means that we're the buyer, have to pay for freight also. But right now, I'm just recording that I purchased merchandise inventory debit, 4,600. and it's on account, so accounts payable. By the way, guys, now we should not be just saying accounts payable. We should say accounts payable dash Lion Company, because it's just easier to maintain accounts payable. There's actually a separate subsidiary ledger. We will talk about it a little bit more in later chapters. And so we have to designate dash who is the supplier. And we're going to do the same with accounts receivable. We're not going to just say accounts receivable. We're going to add dash the name of the customer. Again, there's no discount right now. It's just a transaction that recognizes the purchase of merchandise. Okay, record. Let's go. Again, I can go back so you can see transaction number 2. We paid cash for those shipping charges, right? So it goes into merchandise inventory. What I know it's sometimes confusing, but what you pay for freight increases the cost of your inventory, and you paid cash. That's it. That's the transaction. Oops. Cash. Record the entry. Hope it makes sense. And then transaction 3, April 4th, we returned unacceptable merchandise to the supplier. So I'm just going to reverse my original entry. I'm just going to flip it. My accounts payable goes down for Lion right here. Accounts payable, $600. And my merchandise inventory, I'm shipping it back to them, goes also down. Debit, credit. Record. Check. We sent a check to Lion Company for the April 2nd purchase, net of the discount and return purchases. So right away, remember April 2nd plus 15 days is April 17th. Do I get a discount? Yes, I do. I'm going to first just write the accounts, and then I'll figure out the amounts. And I suggest you do the same. I'm going to pay off AP, so I'll debit AP. Do I get a discount? Absolutely. Where does discount go? Purchase discount goes into merchandise inventory as a credit, and the rest is cash. Okay. What's the amount of the invoice? It was 4,600, and then we made a return. 46 minus 600 equals to $4,000. So what is 2%? Is it 2%? Yes, it is. What's 2% on $4,000? 1% is $40, 2% is $80, and the rest is cash. So 3,000, oops, just a second. So 3,900, where am I? 3,920, that's the amount of cash. So that's the entry. I hope it makes sense. Okay, transaction number 5. We purchased merchandise from First Corp. So we're going to do merchandise inventory. It's $8,500. And it's going to be accounts payable, but now it's First Corporation. Guys, and again, look here for a second. It's FOB destination, which means I don't have to pay for freight. The seller is going to get it to me. I'm the destination. And guys, if I pay within 10 days, so which would be April 18th plus 10 days, April 28th, I will get 1% discount. Okay, let's record the entry. 2 more entries. After negotiations, we received an allowance towards my original amount, and that, guys, decreases the amount of money I owe. Accounts payable goes down by $500. So right now, instead of $8,500, my AP, my invoice, is only $8,000, and it goes as a decrease to merchandise inventory. Again, this is strange, but that's how it is. This is probably a good T account to remember, right? What goes into inventory as increases and as decreases. All right, so record this one. And then, guys, we send the check on April 18th. Again, April 18th, oops, April 28th, April 28th. So we are within 10 days, right? April 18th plus 10 days is April 28th. So we're going to get 1% discount. Again, let me do accounts first. Accounts payable. merchandise inventory, that would be credit, and cash, that would be credit. So accounts payable is $8,000. 8,500 minus $500, so we still owe $8,000. We're gonna get 1% discount, which is 80 bucks, and so the rest of it, which is 7,920, is cash. So that's our these are examples of new journal transactions for purchasing and purchase returns and allowance and purchase discounts. Okay, so guys, I'm going to stop here and I will record selling transactions in the second part of the video. Thank you so much.